Hey everyone, hope you're doing well. This is the Deep Dive. My name is Drew Creekmer. I'm the Director of Advisory Services here at Creekmer Wealth. And today I'm joined by John Creekmer, our founder and senior wealth advisor. And John, there's a lot of stuff in the headlines right now.
Mm.
We got a big inflation number here earlier this week, and there's just a lot of stuff going on. So, today we wanted to get together and really just talk about what really matters right now. What's really important? How do we cut through the noise to get down to the key details that we need to know? But then more importantly, how does that impact our overall financial plans and strategies and the decisions that we're making right now? So looking forward to that conversation.
Mm.
John, when you just think about the last few weeks, what you've been reading and seeing, what stands out to you? What's been interesting that you've seen?
I'll tell you what, things are just like the biggest thing that I'm actually seeing in the media and headlines, and what I'm actually talking to people about, whether it be clients or friends or just people we hang out with, is just how expensive everything has gotten. And you hear all the time. I mean, it could be your gasoline, it could be your electricity, it could be your food, it could be eating out. And Stacy and I, we took about 5 days of vacation, which I can't think of the last time we did an actual real vacation. Typically, we go on a business trip, but we tack on a day or two. But we got away, went to Southern California to a little island we like going to. Yeah, had a great time. But it was amazing. Lunch for the two of us, it ranged between like $45 and $90 for lunch.
Yeah.
And it's just staggering. I was talking to people that were around us, and some were just walking through just different from different areas of the country, and they all had different thoughts. But then even around home, I mean, inflation is just kind of getting a hold, and we have the whole issue over in Iran right now, which is causing gas prices to go up. And I had a personal decision. I have my truck, I have my black car, and I have my little, we call it our ice cream car. It's a 2001 little convertible two-seater that we only drive in the summertime whenever we go to buy ice cream on Saturday and Sunday. So I told Stacy, I'm just going to drive one vehicle until it runs out of gas. Then I'll drive the next till it runs out of the gas. And then I'll drive the third one till it runs out of gas. And then hopefully by then, gas prices will come down. But I don't think that's a real effective strategy in actually dealing with inflation.
Yeah, I mean, totally get making that decision. And we know that's a big deal right now. And so, John, the other thing is we just think about all the clients that we work with around the country. A lot of folks who are retired or either approaching retirement. Inflation is a huge deal.
Yeah.
That really impacts how far your dollar goes, right? We all have big goals and things that we want to do with the years and the time that have now been freed up in retirement. But now we got to be thinking about how does this
Yeah.
inflation issue that we've had really over the last 6 years, how does it impact our
Yeah.
retirement plans? And then do we need to adjust any of the strategies we're utilizing to make sure that we're compounding our dollars to stay ahead
Yeah.
of that inflation?
For sure. So when you think about it, Drew, I mean, when folks retire, some people have a pension. Um, and those that do have a pension, maybe there's a cost of living adjustment on it, maybe there's not. Social Security is a cost of living adjustment. But from what I've seen it play out, typically there's a corresponding Medicare premium adjustment, which somehow equals out to whatever the cost of living adjustment is on Social Security, pretty much. And so, as far as real spending, you have fewer and fewer dollars to have from guaranteed sources. A lot of people, whether they have a pension or not, most people are using something from their investment portfolio to actually generate returns. And historically and academically, people would say you should go to the bond market because it's more stable than the stock market. You can have an income stream off of the bond interest. But Drew, we're seeing things that for people that are not playing out at all that way.
Yeah, they really aren't. And, that really leads into this chart here. So let's just go ahead and walk through this. So this is looking at January the 1st of 2020, all the way on the left-hand side, to where we stand today here in 2026. And this line is actually US inflation over that time period. And so as we walk through this, we had 2020, we shut down the economy and cut interest rates down to zero and had a lot of fiscal stimulus. And so inflation was pretty flat, but then we get to 21 and it really started to accelerate, right? And then we get to the middle part of 22 and we started raising interest rates, which we did at the fastest pace in history to try to bring down inflation, which when I say bring down inflation, that doesn't mean we're reversing the effects of inflation. What it really means is we're slowing down the increase of costs. And we actually saw that play out, right? Inflation flattened out in the latter part of 22, but then it's just been a pretty steady increase here the last number of years, all the way to where we stand today, which is this right-hand side. I know it's small, but there's a big jump up that actually happened earlier this week when we're recording this video. We saw inflation in the month of April here in the United States really take a big kick upwards. And so, John, what's interesting though is when we actually add in bonds to this chart, now we have inflation, which is this orange line, and bonds are the purple line. And so bonds historically, they've been that safety piece inside of your portfolio, right? Now you need to have 30, 40, 50% of your portfolio in bonds because you earn 3, 4, 5% a year. And when markets go down, your bonds aren't going to go down. It's going to help protect your principal. But what we've played out over the last 6 years is really completely different. It's actually the
Mhm.
worst 6 year period for bond performance here in the United States, only up 5.45% over 6 years. And when you factor in the impact of inflation, you actually see that bonds lost about 23% of their purchasing value in that 6 year time period. And so, John, when you zoom out and look at that chart right there, I mean, that's a huge impact, right, on folks' retirement plans and how that impacts inflation and income
Mhm.
living out day to day.
We always hear things that things are different this time. And maybe they are, maybe they aren't. But I think that what we need to recognize is our solutions for how we navigate things are different. And so if we go with the traditional status quo of saying we're going to go 60% stocks, 40% in bonds, and the bonds are going to generate income for us, the reality is that's not played out that way to where you can stay at least caught up with inflation, if not ahead of inflation. In this case here, that strategy actually produced negative returns. So we've been really shifting over the last year and a half to 2 years as far as how we're generating returns for clients as far as for stable income returns. And there's different ways of doing that. There's different solutions. But at the end of the day, you really want to make sure you're saying, hey, I need income that stays up with inflation, that's a rising income stream, that's where my principal is stable or has the opportunity to appreciate. And even last year, we started shifting some monies back in 2022, Drew, I believe it was, when you showed that chart there on how you had inflation even out there in 2022. Well, the reason that we saw that was because the Federal Reserve increased interest rates 11 times over 13 months. That definitely killed the rise of inflation. But what it also did was it decreased the stock market by over 19%, and it decreased the Lehman Brothers bond aggregate index by about 16%. And so if you were saying I'm using bonds in that period of time, well, the reality is you had a negative rate of return of 16% in 2022. Well, we actually went a whole different direction. We brought an alternative investment in there as far as for our clients and their sleeve of portfolios began in 21, kind of anticipating that. And it's kind of more of an option strategy that we have in a tool called a buffer product. That's been able to produce returns that significantly outpaced inflation in that same period of time. And so, and Drew, thanks for bringing that up. So when you look at that, in that, what's the date on that, Drew? Is that from 2020?
Yeah, it's about the middle, August of 2020.
Yeah, well, walk through with everybody what you see there, Drew.
Yeah. So from August of 2020, which is when the buffer strategy went live, which, if you've met with your advisor recently, they walked you through the history of buffers. This is something that's been around for 100 years, but up until August of 2020, it wasn't readily available. And so we were able to bring that to our clients. And this story right here is exactly why. It's August of 2020 to where we stand today. The buffer strategy is up over 80% in that time period, which honestly far outpaces what US aggregate bonds have done, which are actually negative, and inflation. And so, John, this is a great story of saying, hey, we need to challenge the status quo. And yes, in the past number of decades, bonds have been a nice, stable part of your portfolio, but there's always other
Mhm.
options that are out there. And as times change, we need to be changing the strategies that we have in our
Mhm.
portfolio to make sure our retirement and our retirement income is better protected. And I think this
You know,
chart does a beautiful job showing that.
another thing, Drew, we actually started shifting to that you want to pull up. You can pull it up. That'd be great. Is even a high dividend stock portfolio. And so we actually shifted there for some protection out of growth over the last couple of years. And in doing that, it produced some strong income streams. And what we're working on right now in the investment committee is we've actually searched out for all dividend stocks, regardless of size, small, medium, or large size, with a dividend yield of over 4%, with a strong balance sheet so that we know the dividend is not at risk. We're looking for companies that are really what's called dividend kings, increase their dividend yield every year for the last 50 years, and then kind of sorting down from there on some things. I prefer ones that a 1099 is issued versus the K1. But Drew, right now I have a spreadsheet that I'm working through and sorting through for fundamentals, where I have over 100 different companies that actually fit in that classification. And so having dividend stocks could be another option to look at. And I'm not sure if we have data going all the way back or more of a sparse data. It's probably a shorter period of time there, right, Drew?
We do, but you know what I think is interesting here? So let me go ahead and pull this back. So we've replicated this out over the last 10 years. And so this is our high yield stock portfolio. Over the last 10 years, we're seeing inflation. That orange line there is up 38%. US aggregate bond index is only up 16%. So, I mean, goodness, that's 50% less than what inflation did. But that high yield stock, and this is total return. So appreciation plus dividends, that's up over 130%. John, there are times, right, where stocks are more volatile, like back here in
Mhm.
2020, or even here to the upside in 2026. But over a long period of time, that additional earning potential from those consistent income streams that those dividends provide you really stack up to make it a huge impact from an income standpoint.
Yeah, and I think the other one was probably able to show here. We have a lot of clients because of what we've been able to produce inside their growth stock sleeve of their portfolio. They may have some highly appreciated stock, and let's say Caterpillar or Nvidia or Amazon. We purchased, goodness, 20 years ago, Microsoft, Apple. So we have some strong gains in there. We have a number of clients now that we're actually utilizing a covered call writing strategy. We're able to generate premium to give them additional yield in the 5 to 6% per year on the stock that they want to hold as far as their legacy holdings. So even regardless of where a person's at as far as in their financial position, Drew, I think that what we've really started to adapt it to over the last decade is that our strategies must continue to grow and adopt along the way because we know the markets are doing that. Right now, inflation is providing tremendous risk as far as for long-term stability, as far as in the lifestyle folks want to leave. And we need to kind of walk through that. And I would say probably 5 or 7 years ago, I was not a big believer even using a tool such as a structured income annuity. But what we've seen is that interest rates have changed. The product design has become much more favorable for the client. And we're seeing some people now able to structure an income stream of 7 to 8% for life in something where the principal is not at all at risk
Right.
based upon market forces and have a guaranteed income stream that we can build the growth structure around it. So, Drew, I think there's a lot of opportunities there.
There are. There are. And so, what I would encourage y'all to do, we've walked through a lot of things, but I think everyone agrees that inflation right now, just the cost of everything, it's going up drastically. And so, number one, if you haven't talked to your advisor recently here, last couple of months, I would encourage you get back together with them, review your retirement income plan, and then start discussing, hey, do we need to tweak anything with some of the new tools that you all are working on and bringing to the platform to help increase our income that's coming in every month, to make sure we're able to live the lifestyle we desire, but also stay ahead of the impact of inflation over the long term in our portfolio. I think whenever you're starting to see moments like we're living through right now, it's always good to revisit and have a deep dive there. And so, John, with that said, anything else you'd add at this point?
I'll tell you what, something I want to kind of throw out to everybody. There's 16,000 what's called registered investment advisory firms in the that are state registered in the country. There's 15,000 that are federally registered. In order to be a wealth management firm, you have to be licensed with either the SEC or with the state. And so there's 31,000 firms that are out there. And USA Today last year ranked all 31,000 of those, and they listed the top 1,000. And Creamer Wealth Advisors was ranked like number 237, I think it was, in 2024. And so it was a phenomenal accomplishment. That rating came out last April. This year, we got notification from USA Today that we were also considered again. And so the 31,000, they ranked the top 1,000. And of those top 1,000, they've actually ranked Creamer Wealth Advisors number 20, number 20 ranked wealth advisory firm in the entire country. And there's some certain metrics they use on defining that. We've kind of dug deeper on how they actually calculate this. And so the firm is called Statistica, and they do statistical analysis, and then they take feed from clients, they take feedback from industry professionals, and they also look at things such as published articles and speaking engagements, things like that. And it's interesting then, as far as all those 1,000 firms that were ranked, they ranked us number 20 in the entire country. And I think what that really speaks to is a testament to how we're continually learning, growing, we're staying humble, we're developing new solutions, we're helping clients live incredible lives, and we bring it all together. And that's what speaks in summary to what we're talking about here. And so inflation going up, we're talking about education inflation, how it impacts us. But let's find creative solutions to help clients accomplish goals and the risk tolerances they have. And it plays really for a great experience for our clients.
Yeah, absolutely. Absolutely. So, No, that's a huge deal, John. We're really excited about it.
Mhm.
Really thankful for each and every one of you that we get have the opportunity to work with. We're going to keep growing and coming up with new ideas and new solutions to help you all continue to live out your incredible life. And so I would encourage you, if we hit on something today that you're just curious about or even a little bit concerned about, reach out to your advisor. They're prepared and ready to help ensure that you keep on track to achieve your big picture goals and dreams. So thanks for the time, y'all, and we'll talk to you soon.